Hey everybody, welcome back to Young Bucks. This week the panel is discussing Comcast's efforts to buy out Sky and how the Fox and Disney deal may play into that. We're also discussing the new Fed chair Jay Powell, and we're talking about Warren Buffett's passive investor philosophy. Stick around after the panel to hear Andrew speak about the cost of investing. He's going to break down all the fees and exactly how to find out what you're being charged. Thanks for joining us.
Hey everybody, welcome back to What the Buck, the segment when we talk about money. Andrew Hall here, joining me Ben Nye, Sam Frost, Matt Krebsbach. What's up, boys?
What up? Don't forget, this is also a show where we talk about sports.
Yeah, we do sports. I don't think we have any sports takes right now, but
I don't want our followers to forget, so they'll come back next time.
Yeah, come back. USA curling, gold medal. So there you go. I think
Big.
Because the U.S. doesn't win many things, everybody on that team's medal should count as a gold. So it's like we won 4 or 5 or whatever, even though it's just one. So just a conspiracy theory I'm going to try to drum up. Jumping right in here, Comcast taking a beating last couple of days, looking to buy Sky. Some concerns about that. Ben, I know you've got a hot take of a conspiracy here in terms of what they're really doing. What you got?
Well, I think there's a potential that Comcast actually is not actually trying to buy Sky. They just want Disney and Fox to pay a higher price. Because what happened is Disney's buying 21st Century Fox, and 21st Century Fox is trying to buy Sky. And then Comcast is coming over the top saying, we want Sky, and we're going to pay a premium for that. Right now, Fox and Disney are saying that they're committed to the deal, which suggests that they're probably going to enter a bidding war. Question is, does Comcast raise its bid? They haven't made the bid official. It's just a proposal right now, so that this is Comcast. But the expectation is that Comcast will make the bid official and that Disney and Fox are going to have to raise the price.
The sky's the limit. I was waiting on that one. We own some Comcast shares, so it hadn't been the most fun ride. Sam, you got any thoughts?
I don't. Krebs, do you have thoughts?
You pulled your mic like you were ready.
Oh, well, I'll propose this question to Ben. Do you think that Sky in general is a good acquisition target for those companies?
It's
I
bizarre
have my own
because
opinion, but I'll let you go first.
I mean, I think a lot of these companies, especially Sky, is as good as the content that it has. And I think that when you renegotiate rights for things like that, like with whether it's soccer rights or any TV broadcasting rights for sports, I mean, that changes every few years. So I don't really know how you have a big terminal value on that. I think that there would be greater synergies with Disney because of the ESPN Sports franchise, but I guess NBC is trying to do that as well. I don't know. It's just an odd deal, I think, for Comcast to really want to make. I think they should stick to their knitting and stay in.
I think they're going to be
well.
they're trying to break into the international scene, which, I mean, if you're buying rights to Premier League soccer and stuff like that, it's a pretty good way to go about it. But for how many over billion, was it $20 billion? That's a pretty steep price tag.
And is international really that attractive? I mean, I
they
think
would say, yeah.
Yeah, well, I mean, Dish is having problems with that right now, and DirecTV is having issues with that in Mexico right now.
Soccer's the future. I think that's what they're doing here.
Some are calling it football.
This is Talking Sports. We did it. New Fed chair, Jay Powell, inheriting a pretty healthy economy, I think most would say. Employment's looking good. Sam's laughing at that. You good?
Well, I was just laughing because I'm not up to like date on like what's like this guy when he's done, but like he inherited like a pretty healthy economy, like you said, and like day one, I'm way more hawkish than people thought, so the market just tanks. It's like, dude, you had one job.
Yeah, just keep your mouth shut. Toe the line, the company line, and the company being the economy. Let's do that. I don't know. I feel like Fed chair headlines are always kind of something I tend to just ignore, but the market doesn't ignore them. So it's kind of one of those things you have to be aware of or mindful of kind of as a trend and that kind of thing. But it seems to me like it's ultimately going to be more of the same, which is just kind of right there in the middle.
Yeah, I would assume it's going to be more of the same as well. I had a professor who was a big Fed guy, and he used to say that the Fed's goal is to act so that nobody knows that they're there. That means that they're doing their job. The economy is just going along. Nobody's scared of recessions. Nobody's scared of inflation, whatnot. And I would venture to say that everyone on the Fed knows that, and that's their ultimate goal. And so, like, I was joking about this guy. Like, he comes out first thing, he's like, oh, he's super hawkish or whatnot. But, like, I'm sure he understands. Like, the end goal is to almost disappear so that we don't have this every, FOMC meeting, people all eyes on the Fed and, like, what are they going to say kind of thing. It should just be like, oh, yeah, the Fed had another meeting. Everything's going along as planned. And I would venture to say we're working towards that. I just don't know how long that would take.
And that professor's probably going to be on the Fed this year, too. So shout out there. But as far as Powell's comments were concerned, I don't really think we actually learned anything new. He basically said, our view of the economy is improved, and therefore, and make of it that what you will. And, his view of the economy, if the economy starts to level off or get worse, then his view is going to change as well. So I think that saying whether someone's hawkish or dovish, I think is very much a function of how they view the economy. And if they view the economy as strengthening, they're going to naturally be more hawkish because they think inflation is going higher and they need to raise rates faster.
Krebs, you got anything? Do you believe in the economy?
I mean, it just makes sense because, he was penciling, 3 rate hikes in 18? Like, it just makes sense that they have to match inflation with being at full employment. Like, it's just a function of matching inflation and not let it get out of control because that's how you blow stuff up. So, it wasn't really surprising. Like, I guess I reiterate what Ben said.
Yeah. So, be mindful of it. I guess you kind of have to mark your calendar for any time they're making an announcement, specifically as it relates to a potential rate hike. But, I think the narrative would become compelling if he went off track, I guess, in his comments and really deviated from what everybody's expecting.
Over-under's 3. Do you take the over-under or is it push?
I think it's a push, but if I had to take one, I'd take the over.
Yeah, I'd agree. I'd go push, but if I had to go one way or the other, I'd say over.
I would push under.
I'd go under.
I won that bet last year too. People forget that one.
Split panel.
Don't act like you won that by yourself.
Did you say that too?
Yeah, I said that.
I just know Ben was wrong last year.
That's all anybody here remembers. One of our favorites.
I was just early.
One of our favorites here on the panel, Warren Buffett. Sam, I know you're a big fan, so I'll come to you with this first. But he's been chirping his mouth a lot. Old Uncle Warren talking about active versus passive investing. For those out there, passive investing is more or less just buying an index and just saying, hey, I want to own the market or what have you. Active management being more active buying and selling, sometimes even shorting. He's made it very clear over the last several years, really, that he thinks that passive investing is really the way to go. Active management's it's inferior. Passive's the way to go. Sam, what are your thoughts on that, specifically as it relates to coming from Warren Buffett, who, keep in mind, runs what's basically a conglomerate of actively managed companies?
Yeah, that's what I was saying. Does he consider himself active or passive?
I don't know. I mean, I think that's part of the debate. Part of the compelling thing here is that on most recent terms, his company, Berkshire Hathaway, has actually underperformed the S&P 500. So you could argue that that's a case actually for active management. You might want to avoid owning Berkshire Hathaway. They lag the S&P 500. They actually beat last year, but they lag on a 3-year annualized basis, also on the 10, on the 15. I mean, they've struggled a little bit. Nobody's struggled that much. The market's sprinted upwards since 08. But
yeah, in terms of the active-passive argument, that's something that's happened a lot. And I don't think any of us would be working in this field if we didn't believe that active management works.
Right.
So like
we're active managers.
Right. And so I think there's an opportunity. I think we've seen in our own field, you have people who come out and say we're active managers, we're trying to beat the benchmark, and so what do? They come up with an easier and easier benchmark to try to beat it, instead of saying like, no, like we invest in stocks, we should, in the US primarily, we should benchmark to the S&P 500.
Fact of the matter is, active is almost over a long enough time period is going to underperform passive. And here's the reason. Because passive is usually indexed to the largest companies. We're the largest 5,000, largest 1,000, largest 2,000, whatever you have. It's the large companies that have gotten to such a point where they've almost stood the test of either time or they have enough money to really say, we actually have staying power. Versus actives, a lot of activists try to play in more speculative markets where they haven't proven that. So you're just going to get more susceptible to frauds, more susceptible early stage companies that have a lack of strong business going forward. And so I think ultimately there's a bias, a selection bias, and a survivorship bias that exists among passive investments versus active investments. And for that reason, I think that passive is skewed higher than activists. Having said that, I think disciplined active investors should perform well. I don't see a reason why they should substantially underperform passive.
So 2 things. The thing I was trying to get at is that there's a ton of people who call themselves active investors who just shouldn't be in the field. They're just not good. There's a lot of them out there.
We can name names, but we won't.
And I think that's one of Warren Buffett's thing is just that there's so many of you out there. There's no way that all of you can be good, because if everyone could do it, then
it is the market.
Yeah, exactly. And so, but then Ben, you said something else I thought was interesting, because you said that in the long run, active will underperform passive. But I think that in terms of what I think Warren Buffett would actually argue that, and you touched on, you said the disciplined active investor could outperform. And I think that's the big difference there, is that you have a lot of undisciplined investors who are trying to say I'm about to long this company for the next 30 minutes, then short them, and then whatever. And it's they're trying to be these traders, and they're not, and they call themselves value investors, but they're not. If you're truly a value investor, then I think it is definitely possible to beat the market over the long run. But in the short run, it's almost luck. If the market ends on December 28th, you might have actually eked out beating the market if it could have closed on December 30th. So,
and that's a challenge we see. I think the time frame is always kind of stupid on these types of things. Over the next 10 years, this will happen. And we struggle with this sometimes. I can't tell you how many times I've been sitting down writing the quarterly newsletter to clients, and the theme might be X, but it's by the time we're writing it 3 weeks later, if we could tack on 3 weeks, the outcome of the newsletter, if we report it in real time, could be significantly better or significantly worse. And what I mean by that is, maybe we're lagging through, a calendar year period. So on a 52-week period, we're lagging the market. But over the last 3 weeks, we've made up that ground. So on a 55-week period, which no one's looking at, we're actually beating in real time. And that's not a distorted number. It's just, it's not on a calendar year. The markets don't work on calendar years, on months, they continue to roll. It's not like you come in, the first trading day of the year and just hit reset and start over.
And so I think that Warren Buffett would consider himself a disciplined active investor, meaning I don't intend, obviously he wants to beat the market every year, but he's kind of I might beat this year, I might not. I might not beat next year, I might not beat the following year. But you give me your money 5 years later, 10 years later, 15, 20, however long, you're going to be glad that you did. And you will have outperformed the market in that long run. And it's so hard that when active investors are measured on a quarterly basis to say hey, every single company you picked, you said was going to, on January 1st, you said the thesis was going to play out in 1 year, and it played out on December 31st. And so therefore you beat the market. Mm-hmm. A lot of these companies, it takes a little bit longer than a year for the thesis to play out.
Mm-hmm. Krebs, you got any thoughts on Uncle Warren? Boom. All right, last topic we got for today, Lend EDU, which is kind of an educational resource specifically for students who are refinancing student debt or whatever it may be, did a poll of 1,000 people asking what all they would trust Amazon to do for them, specifically in the realm of financial services. So they asked about banking, cryptocurrency, different types of loans, from auto loans to mortgages, whatever it may be, and investing, investment custody and services right there. So the question for you all is, would you trust Amazon to be your primary bank, to use a cryptocurrency that they develop, on a personal level? Would you use them for a mortgage? Would you use them for investing? And if so, which of these categories would you be most likely to use them? And I'll jump in. I think for me, the area I would be most intrigued with would be on the lending side, because lending rates are, fairly competitive in a decent lending environment, and so I'm most likely going to be inclined to use Amazon for something like that, simply because it feels like if they're providing a market rate, there's a little bit of less concern or risk about their ability to deliver that, because at the end of the day, I feel like you're agreeing to terms. You've got that. So I'd be pretty comfortable with that. For what it's worth, 30.2% of respondents said they would use Amazon for a mortgage if Amazon offered such services. Sam, what you got? Banking, crypto, mortgage, or investing? Or would you say none of them, all of them?
So definitely wouldn't go with crypto because it's just such a sketchy field in
That
general.
was the highest rated one. 51.7% said they'd use Amazon for that.
And that's how you know cryptocurrencies are bubbles. But no, I kind of agree with you. I was thinking probably banking or a mortgage because Amazon, they are competitive on price. And so if they, you go through them for your mortgage or whatever, they'll probably offer you a really good rate. I struggle to see Amazon screwing you over. So I'd probably go mortgage.
All right. Krebs?
I think I would do mortgage too for the fact that you're the one, they have the liability, or
Right.
they don't have the, is that hard? Am I thinking that right? They have the liability. They don't have your money.
Right.
I mean, they
Right.
they just have the,
They don't custody.
they just have to lean on your house and let's say Amazon goes BK or something, like legally you'll be fine there if that you have your checking account there. That might get sketchy. I wouldn't be comfortable with that. And same with crypto, same with what Sam's saying. Although it would be nice to have Amazon crypto coins.
Yeah.
It'd be pretty dope.
Am coins.
Yeah.
So just one by one, cryptocurrency, I think that flies in the face of what cryptocurrency is actually designed for. If cryptocurrency wants decentralization, and you have it all at Amazon, like that centralizing
What's
where the
wild
value
about
is
that to me was that 51.7% of people said they would do it. Like 51.7% of people aren't investing in cryptocurrency to begin
it's
with.
not-
But they're like just waiting on Amazon to do it.
it's just not logical thinking. And then for the bank, there's no way that the capital position is good enough. I mean, they'd have to issue a ton of stock to raise that capital. The third one, mortgage, my guess is that they wouldn't actually be holding the mortgage. They'd probably have some fly-by-night operation servicer that is knocking on your door all the time. And then also with that, I just wouldn't want Bezos taking over my house if I couldn't pay my mortgage. I just have an aversion to that. And then, so I guess the last one would be investing. And really, I don't think there's an issue with them at least acting as a broker and just facilitating a transaction, because ultimately they have the liability, similar to the mortgage side, and they have to come through. And if they don't come through, then the exchange will be there.
So a couple data points just in wrapping up. 44.5% of people said they would use them for their savings account, or excuse me, for their primary banking account. Almost 50%, so a little bit more, said they'd use them for savings only. What was interesting to me on the investing side, they broke it down into, would you use Amazon's investing platform, if they had one, for one, retirement investing through like a traditional IRA or a 401k type plan. And then the other side was, would you use a robo-advisor by Amazon? And what was interesting to me on that was the retirement plan actually graded out higher. 36% people said they'd use the retirement side. Only 30% said they'd actually be interested in using the robo-advisor. You've got two components there. One, would you trust Amazon? But two, are you inclined to use a robo-advisor? But I think I would have thought the robo-advisor would have scored higher, just because that seems like something that's so trendy with young people. It's geared towards young people that just want online access to things like that. So I was surprised that was lower than the traditional retirement account.
I wonder if the robo-advisor would recommend buying Amazon stock.
I bet it would. I think you might be onto something there, Ben. All right, there we go. That's What the Buck. We got some more segments coming your way. Y'all have a great week. Talk to you soon. Hey, everybody. Today we're going to talk about a very specific component that can limit your ability to grow your wealth over time. We talk a lot about investing, investable ideas, things like that on the Young Bucks Show, but we don't always talk about the limitations. Sure, here and there we'll call out certain institutions or people that seem like frauds to us, but we don't always talk about the everyday things that can keep your assets from growing. And one of those things is fees. Here at Narwhal Capital Management, we like to talk about the cost of investing. And this is somewhat of a proprietary term, but it basically encapsulates every single fee, which is something that's going to limit your growth of your portfolio. It encapsulates every fee that is embedded into your account. And I think that's something really important to be mindful of. Anytime we take on a new client, it's one of the first things we do. One of the first things we look at is how much were you paying your old money management team, things like that. Whether they were using a robo-advisor platform, a traditional broker at a big custodian, or another registered investment advisor like ourselves, we like to see how much they were actually paying in fees. Obviously, our goal is to keep those fees as low as possible. That's what's best for the client. But be mindful that what's cheapest is not always what's best, nor is what's most pricey always going to be the best option for you. So today I want to talk specifically to young people with relatively small accounts. This is not a conversation for people with tens of millions of dollars necessarily. There are principles here that will apply in that case, but I'm really having this conversation with young people. So let's jump in and talk about some of the fees that you will see in an investment account. First up, I want to talk about brokerage fees. So brokerage fees are going to be associated with the custodian who is holding those assets. That might be Charles Schwab, it could be Fidelity, it could be TD Ameritrade, could be any of these people, could be Merrill Lynch, Raymond James, Morgan Stanley, Goldman Sachs, you name it. There are fees associated with that service. Now, when you hear the F word, when you hear fees, you tend to kind of clinch up and you hate that. Understand, these are people trying to make a living. They're providing a service, they're being compensated for that. So fee is not necessarily a bad thing. What's bad is excessive fees. So when you're looking at fees and you're trying to analyze how much it actually costs to invest, some things that you should be looking at specifically on the brokerage side are this. Number one, trade commissions. When you buy and sell a stock, there's usually a fee associated with that. There's a number of lower cost providers, and so that it doesn't sound like an endorsement, I'm not going to name any of them, but there's a number of low cost providers where you can get almost free trades. Maybe it costs you $4 or $5, maybe it's $8 or $9, but you can find those. On the other end of the spectrum, you can find really high value brokers where every trade could cost you hundreds or even thousands of dollars if it's a very large trade. Those are two very different experiences. For you, for the young person with a relatively small portfolio looking to get invested, I would highly encourage you to use a custodian and a broker that charges a small commission when you execute trades. The biggest reason for that is there's not a real value add to you if you have $5,000 or $10,000 if you're using a broker that's going to charge you $100 every time you make a trade. It's not hard to figure out the impact that can have, and it's not hard to realize that, hey, this trade for $4.95 or $5, whatever, that's a pretty good deal. So take a look at those commissions. Often there's a commission that shows up as well as another fee. Sometimes those fees are mandated by the exchange, and those tend to be really, really small. So you may see a stated fee rate of $5, and in total it costs you $5.17. Not necessarily something to get worked up about, but look at that and understand that. And I think it's really important to note that buying a stock may have a different fee rate on a transactional basis than buying a mutual fund and things like that. So look at the types of investment vehicles that you want to invest in and see what the costs are. And the easiest way to do that is look at what you've already done. Log into your broker. Look at the trade confirms. If you go to transactions, it'll show every trade you've made. If you bought 100 shares of Apple, you ought to be able to click on that, see a trade confirm, and they have to disclose how much of a fee was kept. They have to show you that, and they have to give you trade confirmations. You usually either get them in the mail or through that online login or email. So check that out. See what the commissions look like. So that's one type of fee that you need to be mindful of. The other is an account fee. I'll be real blunt with this. If you're paying a large account fee for a brokerage account, in 2018, you're doing something wrong. Almost everywhere you can get these things free. If you rewind 20, 30 years, sure, yeah, let's throw a fee on there. Nobody really notices. There's an information gap in which retail investors don't necessarily know everything that's going on. We don't have the technology we have. It's much harder to place a trade. Let's put an account fee on it. Nowadays, those barriers really don't exist. So if you're paying a large fee just to have an account with somebody, that's a problem. Look into that and talk to your broker or your contact and see, hey, what's going on here? That's number one. Secondly, beyond brokerage fees, you also need to be mindful of what we call fund fees. Now, it doesn't always have to be a mutual fund. It could be an exchange-traded fund or some other kind of product. We'll ignore hedge funds and performance fees, which we've talked about before, because those are more for qualified, larger investors. But be mindful that every product that you buy that is fund, for the most part, is going to have a fee embedded in that. The single easiest way to discern how much of a fee is being paid is to look that up. So to use an example, if you own IVV, which is an S&P 500 iShares product, you can look that up. And I think right now, I probably should have done this myself. We'll get Chris over there to fact check me. you can type in IVV and you can discover what's called an expense ratio. An expense ratio is something you don't actually pay. You're not writing a check for it. You're not going to see it pulled out of your account. But it's an amount of money out of that pool of funds that is just kept by the administrator and the manager of that. And I believe IVV is 0.04%. So the easy way to think about that is if you invest $1,000, you're really not going to notice this one way or the other. It's tiny. It's teeny tiny. That's a really small fee. So 0.04, or we call it 4 basis points, not a big fee, not something you'd want to get worked up about. Now, if you found another fund and you look at that and you find, hey, this fund has an expense ratio of 175 basis points, 1.75%, something like that, that's going to be something you want to be critical of. You want to look at that and decide, is this manager really worth paying more money for? Are they doing something that adds enough value that I don't mind paying nearly 2%? Because again, you're not going to actually see money coming out of that account. You're not necessarily going to have to write a check to cover that, but that money is being pulled, and that's embedded into your cost of investing. You have to do a little bit of research. A great resource for that is Morningstar.com. You can go in there, you can type in the ticker, you can figure out what's going on and see what the expense ratio is there. So check out Morningstar.com. They're independent. They'll give you some analysis on things like that. So you got brokerage fees where you're going to see your commissions, your account fees, things like that. You've got fund fees, which could be really, really small. ETFs, which are exchange-traded funds, tend to be lower. Mutual funds that are actively managed tend to be higher. You also can have load fees, things like that, all kinds of mutual fund fees. But if you look up that expense ratio, you'll see it. So those two buckets. The third set of fees you really need to be looking at are platform or advisor fees. So if you come to Narwhal Capital Management, we charge you a fee to manage your assets. Why do we do that? Because this is not a charity. It is a business. We have to do that. So we will charge a fee for our quote-unquote expertise. Understand, expertise does not mean we're always right, does not mean every investment we make is going to be profitable and beat the market. It just means that you are paying for our experience, our knowledge, our research, our discipline, our diligence. You are paying for that service. You're also embedded in that, paying for financial planning and some of these softer things that may or may not have to do directly with the investment performance of your account. But you're paying for that. You need to be mindful of that fee, and you need to know what you're paying. If you want to see what you're paying for that, there's 2 real easy ways to do it. Number 1, look at your agreement with your investment advisor. If you come to Narwhal Capital Management, before we can make a single trade in your account or do anything like that, we have to do paperwork, which is basically a contract or an agreement in which we say, here's what we're going to do. And you as a client say, here's what we're going to do. What we're going to do is a bunch of stuff. We're going to build an investment policy statement. We're going to customize asset allocation. We're going to start investing your assets on your behalf. What you're going to do is relatively simple. You're going to pay us a fee. We have to disclose what that fee is. So if you want to look, a great place to start is with your agreement or your contract with your investment advisor. Another place to look is on that brokerage statement. It's going to show every transaction that has happened, and one of them may be an advisor fee. So you can see it there. Obviously, if you're writing a check, you can go back to your checkbook if you actually have one of those and look at that, or just log into your online banking institution and see what's going on there in terms of how much you're paying. When you add all of these things up, so the fee paid to the advisor, the fee paid for any funds that you hold, and the fees paid for transactions, you start to get to what we call that total cost of investing. And that's something you really want to pay close attention to. And you really want to be discerning in terms of what am I paying here for? Who is adding value to my portfolio, and who is just scraping a fee? Understand, it's pretty hard to do all of this for completely free. You're going to have to pay some people to be involved. But what's more valuable to you, paying a broker a lot of money to execute a trade that's directed by an investment advisor, or making sure that investment advisor is being paid appropriately? You have to kind of balance these things out. What's more important, having a cool, sexy mutual fund that performs the same as an exchange-traded fund, or paying a lower fee? You've got to weigh those things. And so I would encourage you to look at these things. The cheapest solution is not always the best one. I think that's an error that a lot of young people make early on, and they say, here's the cheapest thing I can do. It's a free trading platform, a free robo-advisor, whatever it may be. When you get that, you're buying into huge scale, huge sophistication on the technology level, but you're really not getting access to very many humans. You're not getting access to any kind of relationship, any kind of service that has any model above and beyond just what an algorithm is going to do. So be mindful of what you're paying for. On the other side, big fees do not necessarily mean great performance. We see this all the time with hedge funds. We see it all the time when we're analyzing mutual funds. Do some diligence and see who's worth paying. And understand that doesn't always mean the investment advisor. We're an investment advisor. We try to earn our fee every single day with every single client. It doesn't always happen for every single investment advisor for every single client. So that's our calling. That's what we're challenged to do. But be discerning of that. And if you look at those three things, you can start to get a good picture of, hey, what's it actually costing me to invest? You need to look at it through that lens, relative to the portfolio, and also relative to your earnings power and your net worth. A lot of times we see these new models where people are, charging a retainer to young clients. They're charging them $100 a month or $150 a month. How much are you earning, and does that justify that amount of your budget on a recurring basis? Look at these things seriously. If you have questions on that, this is right up the alley of the type of stuff where we can analyze things like that really quickly. Reach out to us. We'd be happy to give feedback. But get educated, get informed, look at brokerage statements, look at your agreement with your investment advisor, look up the mutual funds you hold, see what's going on, know your total cost of investing. It's a great way to limit loss in the future.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.